Welcome to Capital Call, Boyden's podcast series of conversations with private equity and venture capital firms from around the world. In this podcast, Boyden UK Managing Partner Francesca D'Arcangeli speaks with Kolade, Managing Partner at Livingbridge.
Good morning, Wal. Very nice to see you again.
Hi, Fran. Great to see you too.
So thank you very much, Wal, for doing this interview with us today. For our listeners, I'm very pleased to introduce and to have Kolade with us today, Managing Partner of Livingbridge. As part of our private equity practice, we are conducting a series of interviews with leaders of private equity groups, really looking and trying to understand the experience over the last 18 months, and also to look ahead a little bit as we go forward. So, Wal, over to you to introduce yourself and Livingbridge.
Thanks, Fran. So I'm Kolade, the Managing Partner of Livingbridge. Livingbridge is an international private equity firm focused on the mid-market with offices in the UK, London, Birmingham, Manchester, but also in Boston, the US, and Melbourne in Australia. We focus very much on the service sector, so not heavy industrials or manufacturing. And we currently have around £3 billion of funds under management. And our focus is on acquiring interests in businesses with about anywhere from the bottom end, £50 million of enterprise value, up to £300 million at the top end.
Fantastic. Thank you so much, Wal. And looking at your portfolio companies and how they've dealt with the pandemic, what are the factors that have made some perform better than others?
So at any one point in time, we have between sort of 35 and 40 portfolio companies. But going into COVID and the crisis, we had a heavy skew towards IT, and particularly businesses focused on SaaS and delivering software, but also healthcare and tech-enabled services. And that meant that as we went into the pandemic, we were quite well placed. We did have consumer-facing businesses, but they're a relatively small part of our portfolio. And even those that did were very heavily tech-focused. So, I mean, to be honest, Fran, it was a bit of luck, because I sort of liken the way that COVID hit businesses to playing a board game. And, this board game, we've been sort of putting up pieces on the board for advantage, trying to move forward for years. And you look at the board and you're happy. You sort of turn away for 5-10 minutes, come back, and literally someone's gone. And you go, goodness, where are my pieces? And actually, if those pieces landed in the right place, you were fine. If they didn't, you had quite a lot of work to do. For us, I would say it was across the portfolio, we had very light scarring to support our businesses. I think in terms of follow-on funding, we put less than 3% of the NAV of our portfolio into supporting businesses, which is trivially small, given the scale of the pandemic.
Interesting. And for many businesses, the pandemic has affected the approach to hiring because of some of the factors you just mentioned, and whether it's permanent staff or interim staff that was needed in particular. Which skills and competencies do you think were critical during that phase and are now also sort of critical for a CEO and his or her team?
So I think we saw a massive acceleration towards digitization, and the problem with that is that everyone wanted the same people. CTO, CMO, people who could actually sort of make a difference in this environment. The good news, I guess, is that because we had an ecosystem already of being involved, we knew where to find the people and who to go to help us find the people.
Right.
I think in terms of skills, they're sort of basic and obvious, but it's much more interesting about the attitude of mind. So you have to be agile and flexible and also resilient. The problem with when people go into a pandemic or some sort of event like this, so last big one was the global financial crisis, is everyone holds on to the past. A few weeks ago, a few months ago, a few years ago, it was all going great. And they struggle to adjust to the new reality. The answer is, February last year, record profits, record turnover. March, something people, the revenue and turnover fell off a cliff. If you're sitting there hankering back to, I just wait for it to adjust to where it was, then you missed it. And so that involves agility. It involves, resilience and saying it isn't anymore. I need to move forward. And then the skill set bit is around how you take advantage of the opportunities you've got or play into the opportunities you've got. And that's around digitization.
Interesting. Yes. And so with that, do you think there is a function that has gained an importance and that has helped businesses to sort of strategically adapt to the current and future state?
So again, if you look at the sectors which have really profited, so if you're running an online e-commerce business, you probably did quite well, especially if you're selling product and you're able to access customers across the globe. The problem with that, though, is you're now competing in a different way than if you had sort of physical offline stuff. And your ability to access demand is partly driven by your CMO. But if you stand back and take a think about it, in order for the CMO to do stuff, they need technologists behind them. For every bit of sort of tweak they want to do to the website or the process, they need someone to make that happen. So there's a sort of prize for having a really highly competent technology team. Then, of course, you had the sort of the issue around security, which became, I mean, it was non-trivial before, but hugely non-trivial, given you had hybrid working and distributed workforce. Suddenly, the barriers and frontiers of your office were not just, your location; it was distributed across the piece, and your security at one point, if you're not careful, is only as good as your weakest link, which could be someone's Wi-Fi at home, shared with the kids doing online schooling. So it became quite interesting that. So, but actually looking a bit further long term, definitely, your CTO and your CMO are fundamental, because they're the people who are going to eke out the extra gains that help you win in your marketplace. And then if you project forward from that, you've got sort of software businesses, again, very clear what those skills are and needs are. But if you go to a sort of tech-enabled service business where you're pivoting away from what you were doing and using this technology revolution, if you want to call it that, or acceleration, to actually drive your business into that, you need people to understand what you're doing and how you need to move to this new place. And again, that puts you squarely in a sort of CTO box. If you don't have a good, high-functioning commercial activity, then you're in quite a lot of trouble.
Right. And absolutely, the crisis seems to have very much accelerated the digitization processes. And presumably for Livingbridge, that's created some opportunities. But as you mentioned, there are some significant threats as well.
Yeah, I mean, so let's take the obvious sectors which have been absolutely hammered by the COVID crisis. So, hospitality, absolutely. I've never seen situations where you have a business which in a month has negative revenue. You've got to stop and think about that. But actually, there's situations where you actually had to give money back to people. And if you had no money coming in, your revenue is actually negative. It's extraordinary stuff was going on. But that created opportunity. Look, the sector, one might say, was overdone in sort of particularly casual dining, for example. And the property element, which the UK has had a very sort of structured, very difficult property environment to operate in. The pandemic has actually made that much more manageable, because basically the landlords had to adapt to this new reality of, hang on a minute, rental payments fell off a cliff, rental vacancies increased dramatically, the outlook is pretty poor. Either I have vacant lots or I put people in it and sort of share the risk with them. That creates some really interesting upside possibility for you, because suddenly your cost structures are reduced and your ability to make money is reduced. And because a lot of companies went into this crisis in debt or highly operationally geared, it meant they went to the wall. So your competitive position is reduced. The only thing we don't know about yet is demand. But actually, it's not a big bet to say that, you or I are probably tired of our own home cooking, right? There's only so many times you can go to cookbook and do stuff. It's about getting out into the environment and being, interacting with other people other than people you're related to. And that actually is where hospitality could come into its own. And I think it will re-emerge a bit like Schumpeter's creative destruction process, where basically you re-emerge, new concepts come up, not the same ones, new, and they re-emerge into this new environment, actually. So looking at that, we have a couple of hospitality businesses who are really focused on delivering against that.
Interesting. And interesting what you were saying about sharing the opportunity and the risk, in fact, so that it's almost like that value chain is becomes more that everyone has a common interest almost.
You do, because there's nothing worse for a property owner than having a vacant property. You know, if it's vacant for too long, it degrades, and people start asking questions about why it's been vacant, and actually the asset becomes not really usable. So it's better to have someone in there paying you something than having been vacant, and that's quite an adjustment for some property people to play into. Also, there's a sort of philosophy around this, which is, if you think about the fact you had low interest rates, I mean, they're on the floor at the moment. Asset owners, in terms of fiscal asset owners, have profited hugely from this. Actually, their price of their assets gone up, and yet they haven't restructured the way they collect their rents to address the fact the assets have gone up.
Right.
And so that's quite a sort of subtle economic point, but
yes.
Basically the UK economy, and particularly the property sector, has not adjusted and needs to adjust going forward to allow consumer and hospitality businesses to recover and play in. And in the end, 10, 20 years down the road, which is usually the horizon, they should be looking and going, it will be more valuable, but you've got to sort of get through this thing together.
And does that mean that from a private equity perspective, of course, that length to the return is changing, or that perspective is having to change?
It's already changing. So there's been this boom in what people are calling continuation funds. So this is where we create an asset that's doing very well, and because of the structure of the fund, we have to sort of sell it and wait buy. And people address that by saying, well, actually, I've just taken this business from, I don't know, 10 million revenues to 50 million revenues. I'm going to sell it to the next person up, and they're going to do really well from it. Or we could continue by rolling over stakes into the next asset, and then continue along the journey. And we've done, 10 of these, maybe even 15 over our life cycle. And, taking the business from one business making £5 million profit all the way to 50, albeit it's gone through 2 ownership changes in that process. But we stayed long, having the original private equity player that did all the hard work in terms of management, infrastructure, positioning. The next person along brings another dimension, maybe it's international, maybe it's more firepower for acquisitions. You then go to the next person along who does something else different. There's no reason why we can't continue. And you take your return in stages. And I think investors are becoming attuned to that. In this environment where if you have a winning asset, particularly an online winning asset, it's quite difficult to catch up once you're number one. So why would you let go of it? So I think the return is lengthening, but coming in different ways at different times, and investors are becoming adjusted to that. Given that risk-free returns at the moment are, well, in some countries interest rates are negative.
Yes, and there isn't much else to invest in. Right, absolutely. And so, how, with that in mind, has the pandemic changed your approach and access to potential deals? And is your due diligence process now changing in light of the last sort of 15 months?
We managed to do 2 deals entirely virtually through, entirely virtually through COVID. There were 2 in the UK and, or British Isles, we say, and 1 in Australia. And it was interesting, particularly Australian deal, because we were buying a sort of chain of GP clinics, as in hospitals, doctors. And it meant that we were not able to physically meet management and look them in the eye in the same way. But because we had people in these locations, and remember Australia had a really tough lockdown approach.
Yes.
But you couldn't leave, our team couldn't leave Melbourne or couldn't leave Victoria, the state. And the chain was across the whole of Australia. But what it meant was that because you had teams going in virtually, our team was able to use the camera to follow people doing what they were doing. And because everyone could meet online and people physically still there, it meant you had probably 5 times as much calculated interactions with the team and people in your due diligence, because you just took out the travel time and the sort of down wasted time of getting from A to B meant you just had much, much more intense interaction. So I would say it was a richer experience in that sense. I don't think it's sustainable very long term. You couldn't do every deal like that. But actually it meant we had really intense interaction and really rich interaction. The quality of the diligence, I think that's adequate, if not the same, equivalent to what we were doing before, just slightly different. The difference is that for a while now, we've been worried about a couple of things in diligence. One being around the quality of financial diligence. Not that it's not great, it does what it says on the tin, but actually, if you want to capture what's going on in a business, particularly a fast-growing online business or software business, you need to know what's happening, not just now, but likely to happen very much in the future, because we're having to pay forward pricing anyway. Your financial diligence will not get you there. So you have to rethink the way you do that. A lot of that is looking at the raw data and understanding that. And that's basically a sort of, I wouldn't say a desktop exercise, but it's an exercise of sucking in data, analyzing, developing it, talking to management about what's going on, and then developing a thesis about what's going to happen next before the financial results actually occur, which is sort of historic. So, we want to be able to predict in 3 months' time what we think is going to happen trading-wise to a very high degree of certainty. And then you can project from 6 months and what have you. In the way that FDD works, they're extrapolating from very historic data, and we've sort of figured out a while ago that doesn't really work. The pandemic has accelerated this, massively accentuated the need to get stuck into raw data, I'm afraid.
Yes, very interesting about the due diligence process. And how are you having to differently manage that then? Are you sort of taking a different approach going forward as part of your process?
Well, we've got 3 key front-facing investment management activities. So there's the classic new investment people who basically go out prospecting, looking for deals, making things happen. And then you've got the sort of portfolio management, operational, whatever you want to call it, support thing, which I think people recognize. Those 2 we've had in place for quite a long time. We've also got another unit we call the Growth Acceleration Team. And this is filled with data scientists. So I think we got last count, we've got sort of 5 or 6 data scientists. And it is they who are the ones who are looking at and extracting data from potential companies, both outside in and inside, in data that you can then sort of stitch together and get a holistic picture of what goes on. And so the whole thing has become a lot more sophisticated than the past. Generalized, the market's moving like this doesn't really work anymore. And I'd say the one thing that people miss about the advent of the internet, why it's so changed the way you do due diligence, is fundamentally every business who's selling anything whatsoever, service or product, your customer has moved from sort of offline interaction with you, particularly first interaction, to online. Think about Boyden. The first time anyone hears about you will be online. When you go online, you leave a trail, as we know. And the question is, do you understand the language of that trail and how it's sort of structured and what it's telling you about the efficiency of how you're getting to your route to market, if you will. And I liken it to, it's basically maths. And if you understand the maths, you can get advantage. If you don't understand the maths, you can't even play the game.
Interesting.
Okay. So everyone, particularly if you look at the US, which tends to be a leader in this, the venture capitalists, the growth equity specialists, they got this a while ago. And it's sort of seeping into the sort of more traditional world where people are going, we need to understand this. How do we understand this? We've got to understand the data. How do you understand the data? Get people to manipulate it, extract it, play with it, give you the insights. And the critical thing is you're looking for insights. And those insights can be very valuable, very powerful, you get them right. And about 7 years ago, we realized this. And so we started putting a team together. And I say that team is playing a critical role in knitting together our new investment guys and girls with what we call our operational management bit. And it's the missing link, if you will. That basically means you don't sort of do a deal and then sort of lob the deal over the counter to the people looking after it. It's actually a much more holistic approach, a wraparound approach, so that actually we hit the ground running and we get ourselves involved before we get involved in the deal, when we're in the deal, and actually thereafter.
So interesting. So that has an implication, in fact, for the type of talent that private equity is now developing and growing. Interesting.
Yeah, that's absolutely right. And I think, my contention, which I believe I said this pre-pandemic, I'm pretty sure I did, and of course the pandemic means it's entirely obvious now, is that the sort of skill sets you want in a new investment person, particularly young person, is they've got to be very comfortable with some coding and with understanding, not very deep, but basic coding, so they can extract and understand what the insights are getting from the data, because you can't let people run away with it, particularly if you are, you need to ask the right question.
Yes.
And to know what the right question is, and what the quality of the answer coming out is. You can't just leave it to someone and say, you're a data scientist, tell me what the answer is. That doesn't work. You have to have a deeper understanding, integration of what they do in order to make sure you're getting the right insight, the right quality of insight as well.
Fantastic, interesting. So as the market's moving, in fact, isn't it? But as the market moves further, what do you think will be the greatest opportunities for Livingbridge in the next few months, year?
Well, I think one of the things so consolidation of markets is accelerating in terms of M&A, whether it's look at the markets, vet and pet market, dentist, all this sort of stuff is happening. And the key, and again, on a domestic economy basis, that's fine. And you'll compete with lots of people who can do that. The one advantage we have at Livingbridge is we've got offices and access to different markets, so the US and also Australia, which are quite similar in terms of the way the entrepreneurs behave, and gives you access to differentiated deal flow, particularly if you're thinking about doing a buy and build. So there's not a lot of people who can do buy and build, say in the US, and have boots on the ground to help you execute.
Yes.
So
powerful.
It's one thing doing domestic where it's fine, but actually, if you can do domestic and international, you're creating a really interesting asset for the next level up to do something with.
Perfect. Fantastic. And how are you feeling about the next year ahead?
That's a toughie. I mean, I'm feeling better about the next 3 or 4 years, because I think the exit from the pandemic will be a bit bumpy. We've got still a lot of government support in the economy, and as eventually they start to withdraw things, I think we'll see some people who are a bit surprised by just how much government support has been there in helping to keep the economy going. And we have to get back to real job creation as opposed to job preservation, which is what's been about at the moment, and restructuring. I think the next year is going to sort of see a lot of that. But beyond that, I think the UK has some really quite material advantages. Flexible economy, can-do attitude of entrepreneurs, a willingness to take risks, and international outlook. These are quite important in terms of where we're heading, and in terms of building that base for the next wave of GDP growth. I think we're set fair, but that's a sort of 3-5 year out thing as opposed to a 12-month thing.
You've been listening to Capital Call, Boyden's podcast series of conversations with private equity and venture capital executives. To learn more about Boyden's private equity and venture capital practice group, visit www.boyden.com.